If you invested $100,000 into the right ETF, you could potentially generate enough monthly income to cover all of your bills without ever selling a single share. In fact, the compounding power of one fund in particular has been so strong that some investors argue it can actually beat the S&P 500 when it comes to building long-term reliable wealth. Today, we're going to break down SCHD, which is the Schwab U.S. Dividend Equity ETF, and compare it head-to-head against the S&P 500 Index Fund, specifically VOO, the Vanguard S&P 500 ETF. By the end of this video, you'll know whether SCHD really deserves the hype, how it could potentially set you up for retirement income you never outlive, and 3 actionable steps you can use right now to accelerate your first $100,000 invested. Stay with me until the end. I'll also share the hidden advantage of dividend reinvestment that most people overlook and a surprising way to speed up your investment journey without having to cut out every single life expense. Before we dive in, make sure to hit that like button, subscribe to the channel. It really helps us grow and it ensures you don't miss the future breakdowns just like this one. Most people agree that investing in the S&P 500 or in the total US stock market is one of the smartest ways to prepare for retirement. These funds are broad, diversified, and historically very reliable. But there's one major catch that investors often ignore. When you finally reach retirement, the only way to create income from those investments is usually by selling shares. That means your nest egg shrinks over time and you're relying on the hope that your portfolio continues growing faster than you're withdrawing. But what if you didn't have to sell at all? What if the dividends alone could cover your expenses indefinitely while your original investment stays intact? That's the case some people make for SCHD, which focuses on high quality dividend paying companies. So the big question is this: is SCHD actually a smarter retirement strategy than simply holding the S&P 500? Would you rather retire with a portfolio that you have to sell pieces of every single month, or one that pays you consistent dividends you can live off of? SCHD launched in 2011. Since then, despite market downturns and volatility, it's delivered an average annual return of roughly 12 to 13% as of the most recent 10-year data. But here's where the SCHD separates itself. Unlike the S&P 500, SCHD focuses exclusively on companies with at least 10 consecutive years of paying dividends. That rules out a lot of high growth companies that reinvest profits instead of paying shareholders. But it does ensure you're buying into businesses with a proven track record of rewarding investors directly. As of 2025, SCHD holds just over 100 companies. Its top positions include big established names in industries like consumer staples, energy, healthcare, and financials. Think Coca-Cola and Pepsi, Cisco, and Home Depot. These aren't speculative plays, they're companies with stable cash flows and durable competitive advantages. Right now, SCHD's dividend yield is about 3.5%. That means for every $100,000 invested, you'd collect roughly $3,500 in annual dividends before taxes. Compare that to the S&P 500, which typically yields closer to 1.4%. On a $1 million portfolio, that difference is huge, $35,000 per year versus $14,000. Dividends are only half of the story. The real magic happens when you reinvest them. This is called the Dividend Snowball effect. Imagine you invest $20,000 into SCHD today. With a 3.5% yield, you'd collect about $700 in dividends over the first year. Instead of spending that money, you use it to buy more shares of SCHD. Now your portfolio owns a little more of itself, and that slightly bigger base earns even more dividends the following year. Over time, this compounding accelerates. The longer you reinvest, the more the fund starts to buy itself without you having to contribute extra money. Eventually, your dividends can grow to the point where they purchase more new shares each year than you could afford to buy with your paycheck. That's why some investors prioritize dividend ETFs. They're not just betting on stock price appreciation, they're building a growing stream of passive income that snowballs automatically. And to put some numbers on this, let's take that $100,000 example. Historically, SCHD's average annual growth rate plus dividends reinvested, $100,000 invested a decade ago would now be worth over $350,000. That portfolio would also be producing around $12,000 in yearly dividends, or roughly $1,000 a month. Now project that forward over 20 years, that same $100,000 could grow to over $1.2 million, which would be throwing off more than $40,000 $100,000 in dividends every single year. After 30 years, the portfolio could reach nearly $4.5 million with annual dividends north of $150,000. And remember, this assumes you never add another dollar. If you keep contributing consistently, these numbers can climb dramatically. Another reason investors love SCHD is how it behaves during market downturns. In 2022, when the overall US stock market fell about 18%, SCHD dropped less than 5%. And throughout that decline, it continued paying and even raising its dividend. That's crucial for retirees. If your entire strategy depends on selling shares, a bad bear market can force you to sell at the worst possible time, permanently hurting your portfolio. With SCHD, you have a built-in cushion. Dividends still arrive even in rougher years. Of course, this doesn't mean SCHD is risk-free. Dividends can be cut, and no fund is immune to recessions, of course. But historically, SCHD's strict focus on financially solid companies has made it more resilient than broader indexes. And that brings us to the elephant in the room. Is SCHD actually better than VOO, or the S&P 500 ETF? Let's compare them side by side. VOO gives you exposure to 500 of the largest US companies. It's extremely diversified, extremely liquid, and has one of the lowest expense ratios in the entire industry, just 0.03%. It's considered the gold standard for passive investing. SCHD, on the other hand, is more concentrated, about 100 holdings with a 0.06% expense ratio. It's still very cheap, but it is double the cost of VOO. Its dividend yield is more than double the S&P 500's, but it doesn't include high growth names like Apple, Amazon, or Tesla, which have driven a lot of the market's gains in recent years. Over the past decade, SCHD has performed slightly better than the S&P 500 on a total return basis, but that could change. If technology stocks continue to dominate, VOO might once again pull ahead. On the flip side, if value stocks and dividends stay strong, SCHD could widen its lead. The key takeaway is this: SCHD and VOO serve different purposes. VOO is about long-term growth through broad diversification. SCHD is about generating sustainable, rising income while still capturing some solid growth. So which should you choose? That depends on whether your priority is maximum portfolio growth or reliable cash flow. The beauty is you don't have to choose one or the other. Many investors hold both, using SCHD for income and VOO for growth. Now let's talk about something practical. How do you actually get that first $100,000 invested in SCHD? The first step is automation. Set up a system where part of your paycheck is automatically invested before you even see it. If you only invest what's left over at the end of the month, chances are there won't be much. But when you treat investing like a bill you pay yourself first, your wealth starts building without constant decision making. Second, look for expenses you can reduce and redirect to investing. For example, if you cut back on dining out twice per week, you might save $400 a month. Over a year, that's nearly $5,000. Invested consistently, that alone can get you to six figures far faster. Third is focus on increasing your income. That could mean negotiating a raise, switching companies, or starting a side hustle. Even an extra few $100s a month makes a big difference while it's invested and compounded over years. The bottom line is this: you can't control market returns, but you can control how much you contribute. And the faster you hit that first $100,000, the more time compounding has to work its magic. So let me ask you, what's one area in your budget or career where you could find extra money to invest? I would appreciate if you share your ideas in the comments. I'd love to hear how you're making it work, and I'm sure others in the comments would like to see as well. So is SCHD the best ETF? For pure growth, maybe not. For broad diversification, probably not, but for building a portfolio that pays you rising, reliable income for life and potentially sets up the next generation, it's one of the strongest options available today. The real secret isn't choosing between SCHD and the S&P 500. It's starting early, investing consistently, and letting compounding do all the heavy lifting. If you got any value or insights from this breakdown, I'd really appreciate if you hit that like button and subscribe. It really helps the channel grow, and it makes sure you don't miss future videos where we dig into strategies just like this one in even more detail. My name is Chris. As always, thank you guys for watching, and I'll see you guys in the next one.